As usual, it's been another eventful quarter for financial markets. I suppose hot on the heels of 2014, one of the continuing themes that we have seen is a continuation of the low oil price, and it has actually remained quite volatile around its recent lows. The other interesting facet of commodity markets in general has probably been the declining, or indeed the plummeting, of the iron ore price, and we're now seeing some implications of that flowing through into the Australian equity market, particularly outside the likes of BHP and Rio Tinto, where some of the mid-tier players are now looking like they're coming under some financial pressures. In Europe, we've seen the ECB finally implement a quantitative easing program. That's had the desired effect, at least, of seeing the euro depreciate, and we have seen European equity markets stage a broad-based rally on that news. In Europe still, we've also seen the surprise policy response of the Swiss National Bank removing the peg to the franc. And we've also seen the introduction of tail risk again with the election of the Syriza party in Greece. And we think, whilst it's not a huge risk in terms of Greece leaving the Eurozone, it's one that we can't completely rule out. And we think markets to a degree might be a little bit complacent there. One of the other defining features of the first quarter is that we saw 25 central banks around the world cut their interest rates, which included Australia. Outside of our housing market, we actually think that our local economy is still looking quite weak. The exception was, of course, the United States, where, in terms of their policy statement outlook, they removed the word patience, which is quite a significant event because it indicates that the United States is potentially a step closer to hiking interest rates sometime this year. Whilst markets have typically been quite edgy around the change of interest rate policy settings in the United States, the announcement was actually cushioned somewhat, with the Fed saying that economic activity is a little bit softer at the moment, and because of this, the pathway, if you like, of interest rate rises in the future will be a little bit more shallower, and this was actually seen as a positive and placated markets somewhat. So it was a quarter not without challenges, but it was one that proved no obstacles for share markets around the world. Indeed, we saw share markets actually surge. Australia returned in excess of 10%, and global markets returned around about 9.6% for the quarter. So the question really is, from here, what is the outlook after such a strong period of equity market returns? Unfortunately, we're probably a little bit more subdued. We think market conditions will be a little bit more challenging ahead, despite ongoing loose policy settings around the world. Whilst the market seems to be, I suppose, a little bit fascinated with it edging slowly back above 6,000, we actually think a correction would probably be healthy for the local market. To us, the strong run that we've seen in the first quarter has actually taken valuations to levels where we think they're a little bit more stretched, and unfortunately this is also against a backdrop of subdued earnings growth. To us, this usually means that the combination is a bit more conducive to a market correction rather than an extension of the bull market that we've seen most recently. However, offsetting this, we do acknowledge a few offsetting forces. Firstly, as I said earlier, policy settings are still very accommodative around the world, and to a degree I think this has driven some of the M&A activity that we have seen in the first quarter. Whilst these forces could be a positive for the local market, we are also very wary of the prospect of rate hikes in the United States and the uncertain response that it may bring from equity markets. We've seen the taper tantrum in past times. We've seen how the market has responded and waited in bated breath on every word that comes out of the Fed, and we think it is a significant event that the Fed could actually go on a path of increasing interest rates for the first time since the financial crisis. With the markets perfectly poised, if you like, in terms of valuations, or perfectly priced in terms of valuations, we just are a little bit wary about the prospect of rate hikes in the United States and think that this is probably a more important event should it eventuate over the prospect of rate cuts in Australia. So all in all, a pretty constructive outlook for markets as we go through the remainder of 2015, and certainly not one which is a doomsday scenario. But regardless, we always are wary of some of the risks, and we think those risks are a little bit more heightened relative to recent times, and so we should keep risk management front of mind. To this degree, we think that buy-right strategies can supplement a market which is reliant on high yield, and certainly the option premiums that such a strategy can bring can supplement the income that investors desire. In terms of the options market, strategies that use put options can also provide some further downside protection, and we think that this is a very valuable tool for any diversified portfolio regardless of the market conditions.